This brand grew to $50,000 a month without spending a single dollar on ads. All of it organic, the founder's Instagram audience, email, DMs. Then, just about a month before I did my CFO review with them, they turned on ads for the first time. And according to their dashboard, now they're acquiring customers for $5 each. $5. If that number was real, they'd be the best advertisers on earth. But it wasn't real, obviously. And here's the thing, nothing was actually broken. There wasn't any accounting mistake that had been made. This is what happens to any brand that grows up on organic traffic and then starts with paid. The numbers that build the brand stop meaning what they used to. Your average order value drops, your lifetime value assumptions stop applying, and your acquisition cost is going to look a lot better than it deserves to. This whole scenario is very common for creator-led brands that get a lot of their initial revenue from organic traffic. It's almost like you're running two different businesses at the same time, two completely different sets of unit economics for your organic warm audience and the cold paid ads audience, but they're all just blended together. And that can make decision making very difficult. Now, I found all of this running a growth cash dash. It's like a financial x-ray of a brand's real numbers. And this particular deep dive is less about the accounting side of things and more about the ecom strategy. To be honest, like half of the CFO calls I do end up being about growth strategy anyway, which is fine by me. That's the part I enjoy more. But by the end of the story that we're going to go through in this video, you're going to know why average order value falls the moment you turn on ads, why your best customers are actually going to skew your ad math, and how to go about figuring out whether the ads are actually adding new sales or just taking credit for existing ones. So let's get into it. So this is a beauty brand that's led by a beauty influencer. The founder spent years building a real audience. People who follow her, look up to her, trust all of her advice, and like a lot of creators, she decided to leverage that to be able to build out a store that she grew to $50,000 a month in sales. And that's with $0 spent on ads, the kind of metrics that a lot of ecom founders would kill for. So a really healthy performance as a starting point. The only issue is that a lot of times when you're getting a lot of your sales from your existing audience, you kind of have an inherent cap. You have a specific pool of people to whom you can sell, and once you've sold to them, then the only way to get new people to sell to is by growing your audience, which is obviously a lot easier said than done. So they think to themselves, okay, they want to become a little bit more sophisticated of a brand, set up the proper technology and actual infrastructure to acquire clients, etc. And as part of that, they decided to talk to me to get a little bit of an insight from a finance side. So I pull up their data and the foundation is actually really strong. Returning customers make up the majority of their revenue. They have really fantastic retention. They're very profitable. Obviously, if you're not spending a lot on ads, it makes it pretty easy, and they have a very healthy balance sheet as well. But there were a few numbers that I looked at that gave me a fair bit of concern. Firstly, their average order value used to be at around $150, and that had started to drop all the way to $110, a pretty steep decline. And this happened right around the time that they started running ads. Secondly, their blended cost to acquire a customer was only $5. Sounds fantastic, but it's an issue. And thirdly, just because I can't not mention it, their books weren't in great shape either. Just because of all the errors that existed, their finance data implied a new customer contribution margin that was roughly double the back of napkin math that I did properly. It was still healthy, just not that healthy. So they had a lot of numbers, they were saying a lot of good things, but none of them really meant what they seemed to mean. So let's start with the average order value, because there was two things happening in the background that was causing this significant decline. The first one is a function of the fact that they started running ads. See, when your initial buyers are your organic audience as a creator-led brand, then those people will typically show up warm. They've watched the content, they trust the recommendations, they're hungry to buy from you. So when you recommend stuff, they're willing to spend money, they already trust you. And so when all of the customers were coming from the organic audience, the AOV was around $150. But as you start scaling up your ads are meant to talk to people who don't really know you that well. And a stranger is less likely to just go in and buy everything you recommend right on the first purchase. They probably don't want to spend $150 on your full routine. They might want to start with your $27 entry-level product just to test the waters. And there's nothing theoretically wrong with that. That's the whole job of an entry product. You're trying to get that low-risk first yes from a new customer. But as that ad traffic grows, you're going to have now a lot of new customers coming from the ads that are spending far less money than the ones that are coming from your organic audience. And since the AOV of the ad customers is much lower than the organic customers, that's going to start shifting the average blended AOV down. The second thing exacerbated the issue because not only were they now going after customers who were less likely to spend a lot of money on that first purchase, but they were also launching entry-level products that could get new customers in. And this strategy did make sense. Their initial products that they had launched were actually wholesaled products from other vendors. So those products carried about a 50% margin. Interestingly, when I was talking to the founder, I actually asked if the customers knew that particular wholesale product belonged to the founder or if it was a wholesaled product. And the answer was that a lot of customers didn't realize it was a wholesale product, even though it said so clearly on the packaging. They thought it was the influencer's own brand, which is actually a good thing because it means that the customers actually trusted the influencer's brand. And so that gave reason for them to then launch a private label product, which is what they did. And that new product was something they could sell at 85% margins. The only issue is that it was a slightly different product type than the wholesale one. So it wasn't able to cannibalize those sales. It was just at a lower price point. So now you have the issue that you have a new $27 product, which is much lower than most of the products that you used to sell, and you're selling selling it to a new audience that wants to spend less money anyway. But understanding this nuance is crucial because if you do your math with respect to what you can afford to acquire a customer based on the AOVs that you'd experienced in the past, you would be wasting a lot of money. While setting your CAC target does include you incorporating the math from your AOV, when you're a creator-led brand in particular and you have very different customer behavior from your organic audience versus your ad audience, you have to factor in that math separately. So if you set your acquisition cost for ad-driven traffic based on the $150 AOV from organic customers, you're going to have a really difficult time because the ad-driven traffic is only going to be bringing in people who are spending $27 on your front-end offer. And as a rule of thumb, a $27 product is usually too low to work on Facebook ads. The economics only work if you can change how much is spent by these new customers that you're acquiring through ads. And to understand that, we need to go a little bit deeper into a different version of the same idea. See, the brand has two completely different customers wearing the same face in the data. Customer one has followed the brand founder for years. She trusts her. When she buys everything she recommends, and she keeps on coming back to purchase more. Her lifetime value is beautiful. Customer two clicked an ad from somebody they didn't know about 20 minutes ago. They've never heard the founder's name, and they're spending $27 on a product that, whatever, is a good impulse purchase. They feel like it's worth a try. And whether they actually come back is a completely open question. And this is where that second trap lies when you're setting your scaling targets. All of the brand's history, the average order value, the retention, the repeat purchase rate, that was all built by customer one, the organic customer. So if you use that LTV and that retention history to determine what you can spend to acquire customers that are coming in through ads, customer two, that can very heavily skew what your targets are going to be. You're assuming that this second customer is going to behave like the first customer. But the truth is that the ad-driven customer is far less likely to spend as much money, especially because in theory, they are very susceptible to ads by virtue of the fact that they actually bought via an ad, which means that they are also likely to get poached away by a competitor brand who's running ads. In essence, these customers are just less sticky. So the rule is that in a scenario like this, when you're a creator-led brand, you have to do your math differently depending on which source of traffic you're looking at. For a brand that doesn't have the kind of organic audience an influencer might, and all of their customers are coming from ads, it's a little bit simpler because you can look at it on a blended basis and it makes sense. But if you're a creator-led brand, you functionally have these two very different businesses. One is for your organic customers and one is for all the cold traffic. And you need to be able to do the math and understand them separately, which then brings me to the last piece, which is the $5 CAC that we mentioned at the beginning of the video. So what's the math behind it? Well, you take your total ad spend and divide it by all of your new customers, and that's your CAC. Now on a dashboard, $5, it sounds like a spectacular CAC. This is actually a very good example of a concept that all brands have to deal with, which is incrementality. Most of the numbers we use when we're determining how our marketing is performing, like CAC and ROAS, they're directionally helpful, but they are very flawed. Fundamentally, they're just averages, they're ratios, but they don't actually tell us whether our marketing is being effective. The true gold standard of what we're trying to do with our marketing dollars is try to acquire incremental revenue. That means revenue that otherwise would not have happened, that only happened because these marketing dollars were spent. So if I spend $5 on ads and that generated a $20 of revenue that otherwise would not have happened, that would be an incremental $20. And that $20 over the $5 is a 4x incremental ROAS or iROAS. The problem is that determining incrementality is actually a very expensive and difficult process and usually isn't worth it until you're doing several million dollars a year. In this case, it's kind of obvious. If you were doing $50,000 of revenue as it is when you were spending $0 on ads, and then let's say all of a sudden you spend $10,000 on ads and your revenue goes up to $60,000. On a blended basis, that might show you that you have $60,000 of revenue and $10,000 of ads, so you have a really nice 6x blended ROAS. But in a simplified example, if we know that the $10,000 of ad spend generated only $10,000 of new revenue, then that's only a 1x iROAS or incremental ROAS. And this is one of the major challenges that a lot of creator-led brands will have to deal with because it becomes very convoluted to understand what's going on. If all of your revenue comes from ads, it's simple, but when you have that big amount of revenue coming from your organic audience that loves you, it's confusing. This can also be made a little bit more confusing because of things like attribution. Attribution is basically the concept of how you attribute the revenue to different marketing activities. The problem with something like Facebook ads is that its job is to find people who are going to engage with your ads and purchase. It doesn't always know or care that a person was probably going to buy anyway. So if you have a big organic audience and then you start running ads, by default, those ads are going to go to that organic audience first. And it's not to say that those ads didn't push some people a little bit more over the edge and actually drive some incremental value, but the problem is that Facebook is going to take full credit for that value. So if a person was probably going to buy anyway, but then just happened to click on the ad, Facebook would say, I get all of that credit. That person is all me. And all of this confusion around incrementality and attribution becomes a lot more confusing when you do have a large organic audience. It is very much a blessing and a curse. So for this brand, the $5 cost to acquire a customer was obviously not their real acquisition cost. So they had to be very thoughtful about how much they were spending so they're not just increasing the spend because they can afford it. So what did I tell the brand to do, given that that incrementality and attribution is still a very difficult problem to wrestle with? Well, firstly, I told them to try to separate out the traffic. Build out landing pages that are specific for your ads, which make it a lot less likely that an organic audience member will land there. This way you can get a bit more of a cleaner sense as to what people that are coming directly from the ads are doing in terms of purchasing behavior, because you can track it to that landing page. So you can see their AOV and their LTV and their acquisition cost. The second move was to fix the cold offer. Remember the $27 product problem that I mentioned being too low for Facebook ads? The best approach there is to just build out bundles and do offer testing. With an understanding of your avatar and their pain points, figure out which combination of products you can put together that would be something that would be a palatable offer for them. If you can get them to spend $48 or $78, that's going to be a lot easier for you to scale than a $27 product. Not only does that help on the AOV side, but oftentimes a person who spends more money upfront is going to have a better LTV as well, because they're a little bit more ingrained in your ecosystem of products. Now, obviously trying to increase AOV by using a bundle is going to also increase your CAC, but in a lot of cases, your AOV can double before your CAC doubles. So you'd still come out ahead. And the third piece is that once you start to get better data as to which of your customers are ones that are coming from cold traffic, you look at their AOV, their LTV, and try to set targets based on that. The superfans that exist from your organic audience, they're just upside that you get to enjoy through what you can do organically, but your scaling strategy has to make sense for cold traffic, and so the unit economics have to be built around that. The takeaway isn't that this brand did anything wrong. In fact, they did things in exactly the right order. They used the asset that they had in terms of an organic audience and existing trust and built the original business off of that. This allowed them to prove out demand, test out new products, and also build out a base of returning customer revenue and cash flow. It's a massive advantage that a creator-led brand can enjoy that a regular brand can't. The key is to understand the numbers with enough nuance to know that just because things look good on a dashboard or on a blended basis, that's not necessarily the strategy that's going to allow you to scale. If you set your targets based on that blended basis without knowing that the cold audience is behaving differently, you're just going to sink the business. And that's the kind of thing that we dig into with the Growth Cash Dash. See, having clean and accurate accounting data is important, though a lot of brands don't have that either. But then the next step with all the metrics that you have is being able to apply the nuance to understand how to interpret them and how to use that to roadmap out your growth strategy. So on top of taking your historical data and crunching over 30 ecom finance KPIs, the conversations allow us to break into that nuance. That way you can enjoy the benefits of both cleaner data as well as judgment to know what to do next. If you want to have a call like that for your brand, just hit the link in the description. But other than that, I hope you enjoyed this edition of our Cash Dash stories. Tune in for the next one. Take care.